Many thanks to Boonchai. Thank you, John. While we're in this lovely, unique venue in Singapore today, in a few weeks' time, all eyes will turn to Dubai and COP28. And we're delighted that today we have the involvement and the support of His Excellency Ambassador Majid Al-Suwadi, who is the Director General and Special Representative of the COP28 presidency. In his capacity as Director General, he is collaborating closely with the COP28 President to bring the world together at COP28, fostering global transformative climate action. He has prepared some welcome remarks for us, so now for our opening keynote address, let's hear from Ambassador Majid Al-Suwadi. Thank you to the Ambassador for those words. Hopefully we can, over the course of the day, talk about and maybe start to round out some of the ideas around investment solutions that he was talking about, and certainly a lot of attention will be on COP28 and hopefully that will achieve its goals. For the next 20 minutes or so, we're going to look at a couple of pieces of research that will help define the debates that we're having today about transition finance. In a moment, you'll hear from one of my colleagues at ONFIF, Nikhil Sangani, about the attitude of global public investors towards transition finance and sustainable investing more generally. But for now, from our partners, Bain, I'm delighted to welcome to the stage Katrina Cuthell, a senior partner, who will talk on defining implementable and credible transition finance. Katrina, please come to the stage.
Good morning, everyone. I'm Katrina Cuthell, a partner at Bain & Company. I'm delighted to be here today. Today, I'd like to give an overview of some of the constraints and solutions required to unlock transition finance in the real economy. And I hope that this will provide some helpful context as we get into some of the solutions that many speakers following me today will talk about. I'll focus on the energy transition in particular as the key to unlocking our climate transition challenge. The definition of transition finance is very familiar, I'm sure, to everyone in this room today. We define this as the incremental investment to support the transition of heavy emitting industries. This includes several things: financing entities who are committed to transitioning in line with a 1.5 degree pathway, financing to accelerate the managed phase out of high emitting physical assets, and also financing activities that develop and scale climate solutions. And all three of these pillars are very critical. The transition finance challenge is very clear. I'm almost reluctant to add another number onto the pile of numbers that have already been discussed today in this regard. But it's very clear we are currently not on track, and a significant increase in the level of transition finance being deployed is required. Our Bain research is focused on incremental transition finance. That is above and beyond diversion of existing investment or existing deployment that's already taking place. And our research estimates that the global incremental investment of 1.4 trillion is required to 2030, stepping up to 2.3 trillion per annum after that point. And this compares to roughly around 1.1 trillion that was deployed in 2022. So it's clear a big step up is required. We believe we're approaching a tipping point in transition finance that will be signalled by a number of signposts or changes that will occur at different rates across industry sectors and across geographies. For example, regulators starting to mandate transition plans in certain industries, increased scrutiny and focus on the quality of those plans and assessment of the quality of those plans by investors, financial institutions, and regulators. And also things like technology breakthroughs that scale innovations in some of the hardest to abate industries, such as agriculture. While all sectors in the economy will clearly be impacted, energy accounts for 76% of global GHG emissions. And I'm talking here about energy in the broader sense, not just power generation, but generation of all types of energy, and then importantly, deployment of that energy. This makes energy transition the key to unlocking the global transition away from carbon. And it's clear that it requires unprecedented change on both the supply side of energy, but also the demand side industries. The real economy view that I'll summarise for you today comes from an annual survey that we've conducted for the last 3 years at Bain & Company across 600 senior executives in energy and natural resources companies from around 200 companies around the world. As I mentioned, we've run this annually, and so we have the benefit now of being able to see how some of the attitudes and plans are evolving in these energy companies. In summary, this research highlights 3 key messages, and I'm sure many of these will be echoed throughout today. Firstly, the energy transition is not on track. We face a dual challenge of expanding access to energy while also reducing emissions, and we clearly need to decouple these things. Secondly, the energy ecosystem requires far greater alignment. We are seeing promising signs of acceleration in some areas, but slightly more sobering signs of deceleration in other areas, which is slowing progress. But thirdly, and where I'll try to spend the bulk of my time today, we are now becoming very clear on some of the constraints that are getting in the way, and importantly, some of the solutions required to overcome these barriers. Availability of capital is not necessarily the key constraint, but the energy executives that we've surveyed in our study over the past few years are regarding generating sufficient returns when this capital is being deployed as the challenge to solve. A tension between increasing energy supply to those who need it and reducing emissions is at the heart of the energy transition. As has already been referenced today, the world has significant energy poverty. 675 million people lack access to electricity. So we need to simultaneously increase energy supply while reducing emissions, bending the curve, if you will. As we look around the world, today only a very small handful of the most advanced economies have been able to decouple economic growth from energy consumption. And the challenge is we need to do this in every single country over the world. Progress is going to require unprecedented alignment within and across countries and industries around the world. We are seeing signs of very promising acceleration in some areas. We're seeing increased policy support by governments. We're seeing some segments of growing consumer adoption. We're seeing significant levels of private capital being committed and represented by many in the room today. And we're seeing increasing ambitions and commitments and credible plans being put in place by corporates. On the other hand, we are seeing signs of some bottlenecks and constraints. Firstly, bottlenecks in global supply chains and infrastructure, and often it's the infrastructure challenge in many markets that's getting in the way of energy transition. We're seeing global fragmentation and proliferation of policies, not always aligned. We're seeing economic and social considerations outweighing environmental concerns for some consumers, particularly with the cost of living crisis that is emerging in many economies around the world. And of course, capital is now more expensive than it was in recent times. In our survey of energy executives, we're seeing this flowing through to expectations of a slowing rate in decarbonisation in the next few years. The energy executives we surveyed a couple of months ago were more pessimistic about the rate of emissions reduction to 2030 than they were a year ago. They've moved from around a 12% decline to a 10% decline. But on the positive side, their longer-term expectations are unchanged. As we play through what the executives in the energy and natural resources industry have told us, that roughly equates to achieving net zero by 2057. Clearly not the 2050 we would all like, but at least their ambitions over the longer term appear to be unchanged. What's interesting is that the executives that we surveyed are more bullish about momentum in their own organisations' decarbonisation efforts versus their peers or the world at large. Perhaps we could see this as misplaced optimism, but I prefer to think of this as indicating a greater level of commitment within energy companies that might not necessarily be visible to the external world. So importantly, what is holding the energy transition back? This chart shows the proportion of energy executives who selected each of a number of barriers in their top 3. You'll see some at the top of the page are commonly talked about, highlighted in red, were not necessarily prioritised by the energy executives. For example, less than 20% expressed concerns about accessing sufficient capital. On the other hand, at the bottom, you see some of the 2 biggest barriers that come up time and time again in this research. And the main one, and the one which I'll focus on when I turn to talk about solutions, is that 4 in 5 executives consider the ability to create acceptable returns on low carbon projects as being the main barrier to decarbonisation of the energy system. In other words, they see that the capital is there to be deployed, but it's hard to see a pathway to deploying that capital in a way that generates returns that are acceptable to the organisations in which they lead. We see a similar insight when we've looked at the uses of capital across the world's top 125 energy and natural resource companies based on market capitalisation. You'll see we've been tracking this over a number of years, and over the past few years, an increasing proportion of capital is being returned to shareholders through buybacks and dividends, rather than being reinvested in low-carbon projects and transition activities. So it's very clear that when we look at the real-world economy, we need to work through what it will take to unlock more capital allocation to the types of transition projects that will put us back on a net zero pathway by 2050. While there are many examples of innovation globally, we are not seeing this innovation scale quickly enough to achieve the goals that we would like to see. What will it take if availability of capital is not necessarily the core issue for all organisations? I don't have all the answers, but as we look across the organisations that Bain is working with globally, we are starting to see some practical solutions that might offer some accelerated impact if adopted more broadly. First, on deployment of capital, we're three key levers to open new markets and build capabilities required to improve the returns profile that I spoke about as a barrier. First, commercial capabilities. This is about developing pockets of customers who are willing to commit to a low-carbon product or service and pay a premium for that. This often starts by companies examining their customers' own commitments and plans. For example, Genomatica found an early partner in Lululemon to bring plant-based nylon to market that does not rely on petrochemicals. And there are many other examples like that. This requires new capabilities in frontline sales forces and business development functions. Reinventing the delivery of major capital projects is also crucial. We're seeing some leading energy players stress test capacity across the entire value chain that's critical to delivering these projects, and also developing innovative supplier partnerships that incentivise secure supply. And then finally, policy shaping and stakeholder alignment is very critical. And we're seeing organisations invest more and more in bringing insights and analysis to direct engagement with government and industry associations, to collaborate more, to change policy in a way that will support the returns being there. Secondly, and I'm sure this will be discussed a lot today, creative solutions on the provision of finance. Many projects in the energy space are being held back by the assumption that low-carbon projects should be financed by the corporate's own balance sheet. We're seeing energy players co-invest with infrastructure funds on lower risk, lower return projects, or private capital on riskier, longer-term projects. Alternative ownership models are also gaining traction, with some players taking a development fee and transferring the asset to another advantaged source of capital. And of course, in many markets, increased concessional funding from the public sector will be critical. And thirdly, and perhaps most importantly, there are several key enablers that will support the transition finance ecosystem to scale these creative solutions. First, ensuring target setting captures more nuance on the transition journey. In energy in particular, there are very long timeframes associated with a lot of the transition that needs to take place. And so 2030 targets in particular will need to reflect alignment with a net zero pathway versus an overly focused approach to measuring emissions only. Transparent and credible reporting on emissions will be important, and this will help build trust in supply chains between investors and financial institutions and the energy players who are deploying transition finance. And then finally, and increasingly, frontline expertise and tools will be important for those who are at the front line constructing the creative financing solutions. For example, wholesale bankers will need new training, capabilities and tools to be able to engage effectively with their clients on their transition plans and to enable them to assess whether those transition plans are credible and also whether their clients are on track. All of this will require those deploying capital and providing transition finance to collaborate far more closely and to build new capabilities. Only by doing this can we start to solve some of the barriers that are getting in the way of step changing the level of transition finance that is being deployed. Thank you.